All right, so welcome to another edition of the SPRK podcast. I'm one of your hosts, Matt Cooper. So we're here with Chad Bowman, good buddy of mine. How do you describe yourself?
I try not to too much.
Like in a professional context.
In professional context, I've been a real estate agent for the last 7 years. I was a project manager before that. Been in house remodeling, just about anything. Worked in ministry, but really the house world and the investment world was kind of the calling that pushed me forward, and it's what I do now.
So you're an agent, but you're also an investor.
That's it.
Yeah.
Yep.
So we got to know each other because, well, a lot of different ways, but I think initially it's because buying and selling houses. I can't remember if we bought or sold first.
So I always followed, like, every church you were working at. It was like, hey, that's Matt Cooper. I know Matt Cooper's name, and my wife Karen worked with you, but I had not met you until we went to Restoration together.
Yep.
That was the first time I actually met you. Yeah. And then, did we buy or sell first? I don't remember.
I can't remember. It was one of the two, though. I think we bought. Yeah.
We did.
Yeah, that's right.
No, sold. We sold first.
We sold first.
Nope, I'm lying again.
We bought first.
See?
Anyway,
I don't even know.
so
we bought and sold.
So this is what happens when you start getting into real estate. You lose track of whether you bought something or sold something.
Yep.
That's a problem. So we met because you were helping with some real estate stuff.
Mm-hmm.
And then we got to know each other a little better. And from very early on, you talked a lot about investing, some of the uniqueness of the market we're in Lexington. That was like kind of COVID season. Now we have a unique market for a lot of different reasons now.
We do.
But I heard you talk about the uniqueness of real estate investing and what that opportunity was in Lexington. And I kind of like accidentally ended up with an extra property.
It's always a fun problem.
Right. It accidentally worked out really well. And we ended up ultimately taking what my wife Ashley and I had going on and what you and your business partner in crime, Jay, had going on, and we kind of merged all that together.
Yeah.
But I'd love for you to talk a little bit about kind of some of the things you said to me early on about investing in Lexington. And it was those things that got me kind of over the hurdle of, gosh, real estate investing sounds like really big numbers and really risky.
Mm-hmm.
And I've heard horror stories. And so with the framing of that in Lexington, like what was some of that early conversation that we had?
Yeah, I think I spend a lot of my time having those conversations, and you and I did as well. And we were learning some new things as we were going, because the market now is different than the market
Sure.
a year ago, 2 years ago, 3 years ago, and even when I started. So Lexington's just a unique place. We talk about that from your side, like the creative side, and it's an unusual place to have our business based, but it makes a ton of sense because the cost of living is really moderate. Yep.
There's great school system. Like it's a great place to raise kids. We have great access to healthcare.
Yeah.
So it's just a really convenient place to live and really cost effective.
Yeah.
But from the real estate side, I guess, would you say like housing in Lexington is still relatively affordable compared to the rest of the country?
Yeah, I think
like for a primary residence.
For people like me that grew up here my whole life, the thought of what prices are now in Lexington feels weird.
Right. Feels expensive.
To some. But then when you look at it and you actually measure the data and you say, hey, compare this to other cities our size,
Mm-hmm.
or other cities that have similar amenities to us. Are we really more expensive? No, we're usually way cheaper. So in a lot of ways, what we've seen the last handful of years, probably 10 years especially, transformation of downtown.
Yep.
The addition of all these great breweries and restaurants, the shift away from chain restaurants a lot more to individually owned places, all of that kind of stuff changed the culture. And as that culture changed, younger people stayed here. It became a cool place to travel,
Yep.
right? So on and so on. So once all of that really started happening, we see Lexington as a smart investment. We see that as
buy.
Like,
yeah.
And we see that as, hey, this is the price that you're paying now in order to live here is still so much lower than other places. And we think, again, when comparing to other places, we're probably playing catch up to where we should have been years and years before.
Yep.
So we see these big price jumps going on here when other places are going down a little bit in value and interest rates rise and we're still way up each year, each month. You kind of correlate that back to like, we have low inventory, all of this stuff, but really it's because people want to be here.
Yep.
And it's still cheap.
Yep. I remember
relatively cheap.
So I think I came back from Nashville in like 2008-ish.
Mm-hmm.
And I left in 3 or 4, and it was a really substantial difference. I mean, I think the growth of downtown, the amenities, like that seemed to really be catching full wind. And then talk a little bit about the uniqueness of, so we're a city county government in Fayette County, and we're surrounded, for context, we're surrounded by largely like large tracts of horse farm that's protected.
Yep.
So there's been this like development discussion debate that's gone on for several years, and the conclusion of that is like there's not going to be more dirt in Fayette County, right? Because so that's having an interesting effect on the market for the last several years.
Yep.
So is that what it's not only like the cultural drive to be more urban and more downtown and more walkable even. Yeah. We're also like out of dirt.
Yes.
Is that fair?
Yes. So Lexington and Fayette County we were the first, let me get this right. We were the first city to have an urban service boundary in the country. And we're still one of the only ones to ever have had it. And what that does is it puts certain restrictions on what you can build and where. And because of that, there's only a certain amount of land available that's even allowed to be developed. And there's restrictions even within that for how big the property has to be subdivided and all of this stuff. So that's why you don't see a ton of new construction. It's not because there's not a demand for more housing. In fact, in our daily job as real estate agents, we're fighting that all the time with 10 offers on a house, 12 offers on a house, constantly.
That's indicative of not having enough housing
for
enough people
inventory.
Who want to live here.
Yep. And when we dig into the data, we see that it's lowering even more each month, each year. We're down. Let's see, we're in March right now. The last 3 months, our inventory is lower than this time last year.
Wow.
By a significant margin, like 20, 30% lower in terms of inventory, but our pricing still goes higher. We're still seeing, instead of like 12 offers on a house, you might have 8. Well,
it's still a lot.
Only one of them gets to buy that house.
Right.
So there's still 7 people that miss out on it over and over and over and over. So because of that urban service boundary, with that not being loosened up, and I don't know that there's any real end in sight in that right now.
Sure.
That means everything is infill development, which is what it was designed for. They said, hey, what makes Lexington unique is we have all this beautiful land around us, these really beautiful horse farms, but we're still urban enough. But in 10 minutes, you can be outside of the city, or 20 minutes, you can be outside of the city and driving through this beautiful country.
So the decision to restrict the urban service boundary protects the asset of those beautiful...
It protects the character.
Right, the character of town.
What makes part of it unique.
But then it creates a demand on infill development, which is going to be generally urban and downtown oriented and walkable stuff.
Even when I started in real estate, the idea of townhouses and condos was still a real struggle.
Interesting. Like that was a really hard property for somebody to...
Yeah, I mean, townhouses sold just fine, but they didn't rent as high. They didn't gain value and appreciation as quickly. Condos were the same. In fact, when we had kind of the big market downturn back in the early mid 2000s, Lexington got hit pretty much in the condos and townhouses the hardest. It wasn't so much single family homes. I mean, it's not to say that people didn't, take a little bit of a hit, but really it kind of leveled out. But with condos, like, they just tanked because Lexington wasn't ready for condos.
That wasn't a property type that a lot of people were interested in. Yeah.
Now, anytime you're driving around Lexington, you're looking up and seeing condo developments.
A lot more multifamily. Yeah.
And they're usually, part of the challenge is because of the infill development and the lack of other housing available. Now when developers are redoing those infill projects, rather than saying, let's build a bunch of affordable townhouses at, $200,000, they're building luxury townhouses because they have to maximize. They paid a lot for the land.
Yeah, they got to maximize the ROI.
Yep. So they've have to push that higher just to make a return, and that's their business model. So that's what they do. But they've had no trouble selling them.
Interesting.
We saw this on one just a couple of years ago where they were $750,000+ townhouses in a fairly small, section of them, and they all sold very, very well. But I remember prior to that, there was a lot of argument about whether they should be allowed to build townhouses in the single family area, so on and so on. And they built them, and they're beautiful.
Yep.
And there's a demand for it. So even looking back then, like all of that shifts from month to month and year to year. And Lexington is moving more in that direction as we get a lot of people coming in from other cities that really are digging what we have here. They're used to that kind of lifestyle: townhouses, condos, walkability,
and that's the kind of the pressure valve to some of the inventory problem. Yeah, potentially.
Yeah. And one of the things to think about is like there's cool spots everybody knows around town, the Southland Drive areas, the Kenwick, and all of these really cool places. But one of the challenges we still have, I think, is having mixed development within those neighborhoods, so that those neighborhoods have kind of their own little vibe. Like Kenwick recently did that more with, I guess, Wilson's and with Kenwick Coffee Shop.
So Kenwick's arts and crafts bungalows. It's adjacent, pretty proximate to downtown. It's kind of on the north side of a corridor from what his Chevy Chase, which has historically been always desirable because of its location. But it does have its own like flavor and vibe. So you're saying there's some development activity, but it reflects the character of those neighborhoods. Yeah,
and you're seeing it now in Limestone with Gray Line and some of that in Castlewood. All of that
feels very much like that neighborhood.
Yeah. And interestingly, now when we talk to people that, let me back up. One of the more fun things to do is take somebody that's lived here for a long time and drive them to places they're not used to in Lexington. And they're usually shocked at like how cool the character is, in these various parts of town that they never spend time in. Or did you even know this is back here? That kind of stuff. Or walk them through somewhere like Gray Line.
Because so much has changed in a relatively short period of time.
We all have a notion, in our mind of what something is like, and that's all we can stick to. Until we experience it otherwise.
We'll talk a little bit about your like personal journey with investing. So, you worked in project management, software stuff, ministry
all
stuff.
Over the place.
Got into real estate, kind of found your place there. What on the personal side of things in investing, what was your first investing move? Like kind of how did you get your feet wet into investing in the market? Yeah.
So I was helping other people just as a part of my regular real estate job, buying and selling rental properties. And doing that more and more, I had always wanted to invest, but finding the right opportunities and set aside the funding and having somebody really to walk me through like the ins and outs of how that worked. Because it's different than just going and buying your own, personal home. So we finally kind of jumped in, my wife and I did, and bought our first property. I guess it was 2019. And we bought that with my cousin, Jay, and his wife Stacy, and we basically partnered together and turned that house into an Airbnb. From there, understanding the ins and outs of the financing became almost like an addiction to me of like, this is really interesting. This is different than my other stuff. So my wife and I started purchasing, oddly enough, a few townhouses because the prices were lower, but the rent value was really high. And so I was buying them, kind of remodeling, doing the BRRRR strategy. So we were buying it, putting some effort into making them nicer, renting them out, refinancing it, doing the same thing over and over. So we kind of just started doing that in a domino effect. And then you guys jumped in, and after showing lots of people, working with investors and showing different people, different types of investment properties, you realize we're all looking for, some of us are looking for the same kind of thing.
Sure.
And then some of us are looking for stuff that's totally different. So I haven't struggled with like trying to make sure everybody gets fed well with what investment type they're looking for. So when you guys came in, it was like, we're all looking at the same stuff. We're hanging out. We have the same goals. Let's just join forces and do this together and find a solution that's scalable, in investing.
So your first kind of experience investing was you did a short term, and then you really practice the Burr method, and that was about, I would imagine, gaining equity so you could go lever it to go do another property.
Yeah.
Yep.
Yeah, and again, that was something like nobody ever teaches you this in school when you first start out.
No. Well, and you said to me early on, which is part of, it was probably one of the big things with making the real estate investing idea click, because it seems really, I think for those of us in our professional life that don't buy and sell houses every day, like the transaction process of selling a house or buying a house, what's the average person do that couple, 3 times in their lifetime?
Right.
And you do that probably 2 or 3 times a day.
Right.
So a lot of that process seems really daunting and foreign, and the numbers are really big. And it feels like there's this huge risk profile.
Yeah.
And in some ways that's a barrier to entry that I kind of like now, because it means that it keeps people away from like competing for the same properties that we want. But that was a really big hurdle for me to get over.
Yeah.
There's also like the concept of leverage, which I remember listening to a lot of the Bigger Pockets podcasts. And it's one of the things you and I talked about. Like I feel like sometimes there's like a little bit of they're a little tone deaf to the idea of leverage, but leverage is cool as long as it's
when done
okay
right.
when you exercise it properly. And you said to me early on, there's a big difference between buying a house for, like your personal residence, because it's very emotional, it's very personal. However, the investing side of things, it's all math. It really is a spreadsheet. Yeah. And you can look in a house and very quickly fill in the data that you need to complete your spreadsheet. So it's more of an academic or a mathematical decision than it is an emotional decision.
It is. And the other part of that is part of what we teach a lot in our day-to-day business, and what we focus on when we're looking at properties is every property has its best use.
Yep.
So something that is a fantastic short-term rental, from a math perspective, may be an absolutely terrible long-term rental.
Right.
And vice versa. So, and that can be based on what area it's in, or what the size of the house, or the specific details of it.
Cost to potential rent ratio.
Yeah. So a great example, the first one that we jumped in on and made the short-term rental, I was trying to sell the house just as a regular listing. And this was in 2019, so it wasn't like the market was bad.
Right.
And this is in a fantastic neighborhood near the Arboretum. Everything sells over there super well.
Right.
We could not get this one under contract, and it was listed at 240, I think, 235.
So it's almost like it was a fluke, like a calendar fluke or something.
And again, it sat for like a month. So it wasn't like this long runway.
But in those days,
nobody wants it. But I kept telling people that were calling, like, this would make a great short-term rental. And the feedback we kept getting for why nobody wanted to buy it is it had a steep driveway. So it's like, okay, yeah, that's a knock on it, but everything else about it is remodeled. It was wide open floor plan. It had 3 bedrooms, 2 full bathrooms, all of this.
So it didn't fit that criteria.
It didn't fit it for somebody.
For a personal.
Yeah. Now, if we tried to stick it on the market now, I'm sure it would be great.
Sure.
But all of those negatives, or really the one negative that kept somebody from buying it, nobody cares about as a short-term property.
Right. That's not an issue.
But because of the price of the home, because of where it's located, the value of it, how it jumped in value, it also meant that one, in order to cover expenses, mortgage, all of that stuff, you really need it to be a short-term rental. If it's a long-term rental, you're probably breaking even, not really cash flowing a lot. So we teach a lot, like, evaluate what the property is, know your risk level. So if you're somebody that says, I can't stand the thought of doing a short-term rental.
Yep.
The stress of having to manage that,
and,
or whatever.
And the turns and all of that.
Yep. Or vice versa. If you say, I can't stand the thought of owning a long-term rental and having people call me every time there's something broken or whatever, but I can't afford to pay a property man. All of those things play into it. So you have to look at each scenario and decide what's its best use, what's my particular risk level as an investor in terms of what I want to do with the property, how often I want to get a phone call, whatever. Yep. For us, we kind of love that stuff. It's like, it's totally fine. We've got systems set up to handle all of it.
And the benefit, one of the benefits from my perspective of us kind of joining forces, and you could argue you dilute your position, but we ended up with this team so we can shoulder a lot of those things. So all of a sudden that was a really high concern that I had when we had a single property.
Yeah.
The phone call when we're on vacation, which happened, and the fridge broke, which happened, which we had to, now we've got a team of us to kind of shoulder that burden. So that's not even a consideration.
It's not a big
anymore.
consideration. Yep.
So to drill down a little bit on, I agree that I think our little group shares a common set of expectations, or like the reason why we're investing.
Mm-hmm.
What was the reason for you to invest in real estate? Was it about immediate cash flow? Was it more for the long term and retirement? And
yeah, my particular strategy, which again is person to person, is I don't live on the money now.
Right.
So in some investors, they need the cash flow immediately because that's replacing income. That's great. For that strategy, there's certain properties that work. For my family and for the way that we were operating, and you guys as well, we're not living on the cash flow from it. We're looking at how many properties can we acquire, take care of well, treat people well that are in them, right, and watch them appreciate in value. So the long-term goal is just to see how much those will gain in value while somebody else is paying the mortgage.
Right.
Everybody has their own goals of what they want to do with the money when you cash out of each of those investments in the long run. But for me, it was really about long-term appreciation. And because of that, some of our specific strategies are driven more by that than it is, again, if your cash flow.
Yep.
Yeah. And we have kind of a nice balance of that between short-term and long-term and commercial property. But with it being an appreciation-minded
and to frame
value.
that up in terms of where we are in that process in our own lives, that's a 20-something year-long time horizon.
Sure.
So if we acquire something now, and even if that gets traded into a different property, our investing horizon, we're talking about like 2 decades plus.
Right. We've got a long runway, which works well for us. But because of that, since our goal is appreciation, we're kind of looking at which houses we think are going to have a couple of those kind of jumps in value along the way. Because if we're paying at the absolute top dollar right now, and we don't think that it's going to gain a lot of value, then it doesn't do us as much good other than, hey, it's great, somebody else is paying the mortgage, we're renting it out, so on and so on.
Right.
But
it doesn't have that potential bump.
Yeah, the sweet spot is, we bought some 3-bedroom, 1-bath, single family ranch, 1,000 square foot houses. They're all over town a couple of years ago. And it was with the mindset that these are the barrier, or the starting price for a home at the time was those 3-bedroom, 1-bath around $130,000, $140,000.
Crazy.
Yeah, I know now.
But
and this was just a couple of years ago.
Yeah.
But we knew, as much as the value of houses are jumping, the houses that are 800,000 and above are not going to be jumping as
their potential
fast.
Delta is much smaller.
Yeah, because the buyer pool is a lot smaller. So instead, we're looking at what are the lower price homes and watching those, knowing that they're going to jump in value because of what's happening in the rest of the market, the middle of the market, where the median prices are really living when they're going over asking, in 10 offers and so on and so on. So we knew that's going to get pulled up. These 3-bedroom, 1-baths are going to get pulled up. But I remember when I first started in real estate, investors told me, like, those are the worst investments you can make because you can't fit as many people in them. There's only 1 bathroom. There's no garage.
Yeah, like basically don't buy the bottom of the market.
Right. You want as many bedrooms, bathrooms, garage. That's how you make money. And that's true for certain places. But you also have to pay a whole lot more money in order to get those.
Right.
So again, every investor is different. Some people only want to buy newer construction. Some people are fine with, 1970s 3-1 ranch.
Yep.
So we were able to watch the appreciation jump on those, which then opened up those options for leveraging deals and all of that kind of fun stuff to move around. So because we have that long 20-year plus runway, we can watch, and as things start to slow down in appreciation because they've kind of had their jumps, we can take that money, cash those out, moving into more properties.
Yeah, when we talked, a lot of our conversations as this was kind of evolving, what really resonated most with me was this idea that if you're looking at that long time horizon, that is kind of the antidote to the risk of leverage.
Yeah.
So my biggest hang up, and I'm sure a lot of people would have the hang up, like the risk of leverage, and the guy in Tennessee that has a radio show that I don't always like his financial
shall not
advice.
Be named. Yes.
That shall not be named. I gave him too much airtime earlier today in another episode.
Oh no.
There's there's like a grandma's wisdom. Would you borrow money to go invest in the stock market? Which I think that pokes on like how cognizant are you of leverage? Now I wouldn't, because I don't like that bet. But
Right.
that isn't really leverage's problem. That's because I don't like the bet on the market, because I don't have a set of tools that I can flex to buy cheap and sell high.
Yeah.
But in real estate, there are tools that we have to fix up a property, and there are tools to deploy where we can get a attractive purchase price,
Yeah.
and with a fair amount of certainty increase value.
Yeah.
So when you spread that out over a 20-year time horizon, the risk of the leverage becomes a lot less offensive.
It
I think
does.
that was one of the keys to like kind of getting me over the hump.
Yeah, and it's similar in stock investing, and you say like put your money, diversify it, and then leave it. Not
Right.
necessarily in the exact same allocation, but leave it and let it roll for a while.
And take advantage of that long horizon.
Yeah. But at the same time, we're almost, for lack of a better word, day trading, but in a much longer time frame, by constantly watching and saying, here's this interesting thing in a segment of the market that's going on. We should pay attention to this. Let's roll something over into this
And kind of exploit this growth
for a while. And
Yeah.
then when that's kind of tapped out, then we can move it over here. Because one of the fun things with real estate investing is once you've acquired properties, they become easier and easier. Banks like to give you more money, which today's not a great day to talk about the banking market. But anyway.
Yeah.
But
Hey, mortgage rates are down like 1.5%.
they
right?
are. They
Yeah,
are.
There you go.
But it's easier and easier to start acquiring, but at the same time, then you can start looking across your portfolio and realize, like, how do I move things around that make sense?
Mm-hmm.
When is it time? Because it always feels like in a market right now where everything's going in these crazy offers and so on, even with the interest rates higher, it's tempting to say, you know how much money we could make if we sold all these right now?
Right. But that
But we could
violates.
have said that last year.
Yeah.
And now we're like, hey, we have even more now.
But that violates your long-term
It does, because
horizon.
you got to have somewhere else to put it.
Yep.
Right?
Yep.
So that's
And
kind of the
there's
interesting
capital
thing.
gains is a real thing.
It is, yeah. But I think at this point, like paying attention to the segments that are going on in the specific areas you are investing, because Lexington's a really great market.
So
Some of our surrounding counties have become really great markets because of the overflow. Georgetown's an incredible place to invest in now. Again, years ago, I would not have thought, hey, I'm going to go dump money into to Georgetown or Nicholasville or these other places.
So like
Now
the
I wouldn't
bedroom
hesitate.
communities all of a sudden get really
Right,
attractive.
but
yeah.
Lexington's different than San Antonio or wherever else. So everybody's strategy has to be based on what your market is.
What do you think? Are there some things you think that people who are considering investing, they're really key piece of information to know? Are there some like hidden jewels of wisdom? Maybe specifically in, I mean, I know we always say it, but like we said 19 and 20 and 21, 22, and now like, oh, it's a really unique market.
Yeah.
In this specific market, end of quarter one, 2023, what do you think the opportunities are to exploit in Lexington if you're looking at investing or you want to get more serious about real estate investing?
Mhm.
Like where's opportunity right now?
So in the market where we are, where interest rates are higher, that makes a significant difference on what you can purchase. It's not even the sales price part of it, because those, like the rent market jumps almost as fast as the purchase price market does.
And in other words, the rent market is going to price in the interest rate.
Yes, because as an investor is spending $250 on a house that they were spending $200 on, a year ago or a year and a half ago,
all that gets priced in.
Yes. So what you have to pay attention to is with the interest rates being 6.5%, 7% on a commercial loan, which is a whole different thing. You have to pay attention to if I'm putting 15, 20% down as my minimum entry for that investment,
In terms of cash.
can I even cash flow? Because if I can't cash flow, the bank doesn't want me to borrow it.
Yeah.
Right? They don't want to lend me the money. That's why the commercial loans ask you how much you expect to rent the property for.
Yep.
So it changes the dynamics of what we're doing now. So now, before I would say like when the interest rates are 3.5%, even on a commercial loan,
capital was cheap.
then I'm saying just borrow 15% if you can. Or I'm sorry, just put down 15% or 20 at a minimum, because you're going to cash flow well because your payment's lower.
Yep.
Now I'm looking at it going, okay, you might need to put 25 or 30% in order to meet the standards for the bank and for your own sake so that you're not paying out of pocket to cash flow. But again, that's on an appreciation model of saying
a long-term appreciation model.
Yeah, I'm not trying to make, a ton of money a month. I mean, it'd be great when you can.
Right.
But more than that, I'm just...
So when you're saying cash flow, in the mindset of my real goal in owning the real estate is the long-term appreciation and the long-term strategy for the property, cash flow is I need to pay the expenses and have an acceptable cushion of buffer.
A buffer for the various things.
And I need to meet the bank's requirements for minimal requirements for cash flow so I can get financed. But in the mentality of I need the money now, cash flow looks a lot different because there's like a today income requirement attached.
Yep.
Okay.
So in some respects, like some strategy people should pay attention to now is either find a way to put a little bit more cash into it and acquire a property now because, again, we only see data showing that it's going to continue to grow. Now, obviously no guarantees, but in our market, specifically to Lexington and our surrounding area, it continues to grow. We're, again, Q1 of this year, seeing ridiculous numbers that we did not think would happen in the fall.
Ridiculous numbers in terms of appreciation or terms of value?
Both.
Okay. And that's driven... The driving factor behind that is that the inventory
is so
more
low.
People that want or need housing than we have housing available.
Yeah, because right now people are not moving. Like you and I are not going to move and make a lateral move on a house because
the cost of money is too expensive.
Yeah, if we're locked in at 2.75 or 3%, I'm not going to make a lateral move. So I have to have either a lifestyle change, like, hey, we're having kids or whatever, job changes. Something has to propel you to want to move out of the house and move into another one. Where before, we were just trading houses because we could. Now you don't, right? So our inventory is continuing to get tighter instead of looser because all the people that refinanced or bought a house in the last handful of years when it was 4% and less can't afford or don't want to afford to move and increase their payment by $1,000 to have the same house.
Yeah. So none of those properties are coming onto the market. That also means that's a group of buyers that aren't buying, there aren't properties to sell. There aren't buyers.
A lot of first time buyers, a lot of investors, a lot of people with life changes and including life changes of moving into town. We have a lot of people coming in, and that was especially true during COVID time. We were getting a ton of buyers from California, Washington, Oregon, Illinois, and New York.
Interesting.
Just tons of people flooding in. So like probably 30-40% of the phone calls we got on a certain range of properties were people from out of state.
Really?
Buying more or less sight unseen.
Interesting.
So you're getting that kind of thing. But I think that one of the challenging things to even contemplate within the inventory issue is a lot of people that are still in the same jobs that they've always been in can't necessarily even afford the same house if they were to buy it again.
Yeah.
If they had to buy it in the interest
capital.
rate. Yeah. They couldn't afford it or wouldn't want to afford it. So as long as interest rates are up like that, it's going to be a struggle for inventory.
So what I hear you saying is if your purpose in investing is that kind of immediate today cash flow, that's going to be a lot harder to achieve because your margin is much tighter.
You've got to get a great deal on a property.
Cost of money is really, it's going to be hard to get a great deal on a property because there's a lot of competition. Because the inventory is small. And cost of capital is really high. So you're going to have a really tight margin to operate in. But for more of our philosophy, which is long-term oriented and appreciation oriented, there's still opportunity because, again, nobody can make a guarantee, but the houses aren't getting any cheaper.
Right. There's only so much land. Nobody's building more land.
So if you can make the math work, and that may require more cash injection than it has in the past, then there's the opportunity to make money because we're looking at a 20-something year timeline.
Right. And you have to loosen some standards. Like a lot of people, even in the purchase of their own personal home, investors kind of think the same way a lot of times when they first get going. And that is, I only want this kind of house and I don't want to do a bunch of work. And I want it to be...
I don't want a townhouse.
Yeah, I don't want a townhouse. I want it to look like it just fell out of a magazine and it's beautiful and I'm going to rent it for $7 million, right?
Right. Sounds great.
It does. So on our side, looking at it going, hey, you know what? We have to be more willing to invest money into fixing the house. Or the long term of saying, okay, this kitchen's okay now, but next year, after this first tenant, we should probably plan setting some money aside and plan to go ahead and redo it then. You know, you have to start kind of figuring out what
being
you're
a little
okay
more
with.
adaptable.
Yeah.
Okay.
Yeah. And okay with, again, sticking to your numbers. Because I think back to your question about advice for right now in the market, it is know what you want to buy, know what your risk level is, have a decision made before you look at properties, and practice evaluating properties that you have no intention of buying. Practice evaluating the numbers on them so that when those come up and that it is something you can afford to jump on, you've already had the mental exercise, I guess, of understanding how to evaluate that deal, if it's a good fit for you, so on and so on. Practice it, then do it. But along the way, be at least somewhat flexible in understanding that property might shift from this neighborhood to this neighborhood, or this level of work to this level of work, so on and so on.
I remember really early on, you were very gracious to let me go look at a bunch of different properties with you to practice that kind of, like evaluate the thing. And so if somebody's a potential investor, they want to try to get their feet wet. I mean, what's protocol with real estate agents? If I said, hey, I'd really like to go get my reps in on evaluating properties because I want to try to figure out an investing move. I mean, is an agent like willing to go?
I am.
Okay, you are. All right. Well,
Jay is. Yeah.
We'll describe your contact info at the end of this podcast. So that's like a cool thing to do. That's a great way to get practice, and you can kind of try on the decision before you actually make the commitment with money.
Yes. Again, one of the keys is you have to have somebody guiding you through each of the steps along the way.
You need like a shaman.
If you do a real estate shaman. If you have not done this, you need to pay attention to what other people are doing, follow them around, because again, I have lots of friends that are investors and we do things differently from one to the next. I have clients that invest in totally different properties than we do, so on and so on. So sitting down with an agent like myself, like Jay, and saying, I need to learn this. I want to have help. I need you to guide me, but let's figure out what we're doing. That's usually the first step. So I will pull up spreadsheets and show people, here's how we evaluate a deal. I'll pull up houses that we've either purchased or that we've sold and say, let's walk through why this works.
Here's a hypothetical scenario that's based on something.
And we'll start with that kind of research and then show people, here's a house and here's why this would not work with this strategy. We'll just pull one up on the MLS now and look at it. From there, once you get a little bit of understanding, then it's like, okay, you think you know what you're looking for now. Let's go check out a few just so you can practice that. Yeah. With the understanding, usually just as a courtesy for the other agent that might be listing a property, I'll call them in advance and say, don't worry about chasing us down. This is more of an educational thing. Are you okay with us taking a time slot? We'll fit it in when somebody else is not.
We'll take a low priority window.
Yeah, exactly. Right. We'll do the 9 a.m. showing. Nobody else is going to be there.
Sure. Awesome. Good to know. 9 a.m. showings, a lot of opportunity.
Right. Well, and again, part of the reason is just like when you're buying your own house, people don't know what they don't know. And they often come in with a list of demands and they walk in a house and they go, you know what? That's not really as important as I thought it was. Turns out this part of it really is instead. So your list changes all that. And the only way you can know that's going and looking.
Yep. So if people want to find you in the world or on the internet, where do they find you?
So I'm with The Brokerage. And we're here in Lexington. And you can get me at chadbowmanrealty.com. I'm on Instagram, same thing, Chad Bowman Realty. You can send me an email. You can call me on the phone, 859-396-5256.
Oh, that's an impressive
Had that phone number for a very long time.
That's great.
But yeah, we've been doing some seminars, trying to teach people, some of these practices. So we'll be doing some of those in the future as well with myself and Jay Pennington.
So it sounds like if somebody is interested in investing, they should definitely find you and try to get together with you to learn a little more, even if it's like today is not the day, if they want to start figuring out that
far in advance. Sometimes that's the absolute best way because that education takes a while.
Yep.
And again, you need help walking through this. If you try to do this on your own, especially without much practice, that's where investors fail.
Yep.
Is when they're like, well, I just wanted to do this, so I went out and bought this house, and I'm going to spend way too much money fixing it up and then try to rent it out, and then they lose money on it. So again, we need to educate on how to actually do that wisely and what's important in an Airbnb or a rental or, any of those things.
Awesome. All right.